Okay, so for people that can hear, this is Option Trading for Rookies, presented by Sharper Trades. My email address is right below, right here. If you need to reach me with any questions, I'm always up for answering questions. So just email me at cal@optiontradingforrookies.com. So what is this we're going to learn today? This is an advanced strategy, but don't let that scare you, because even if you're not an advanced trader, I highly recommend just going through this just to see what is out there, because you don't know what you don't know. And this is a good thing to learn about, and it'll be a strategy you get to eventually. For some of you, maybe this is something you're doing already, who knows. But either way, beginner, middle, or advanced, this is definitely worth sitting through. So today we're going to discuss something called the short put, about earning monthly income. And like I said, it's called the short or naked put. So who am I? First off, my name is Cal. I'm actually one of the original rising stars over at a place called Tastytrade.com, which is the largest online financial network in the world. The only reason I put this up here is not to brag, it's just to show you that I've done the work. I've spent the last about 6 years now and thousands and thousands of hours learning this stuff. And with my background as a writer, I've tried to take everything I know and distill it down to basically what do you need to know to be able to trade as quickly as possible without learning all the excess. So with that being said, all my courses are kind of designed this way. I use the driving the car analogy for all my courses and the way I teach. What I mean by that is this is all the pieces that go into a car. This would be essentially my 6 years and 10,000 hours of learning to get to this point. But do you need to know all this stuff in order to drive a car? Obviously you don't. So that's the point of my courses, and the way I teach is I've learned all this so I can put it into this format and allow you just to drive the car and get up and running as soon as possible. So what do I hope you leave here with today? Well, a few things. One is a way to buy stocks at under market value, a high probability way to earn a monthly income using options, the ability to pick your winning percentage on every trade, and more than anything, hopefully the desire to learn more, because this is just one of many strategies that you can use. So the strategy of shorting puts. What are we going to do today? We're going to learn when to use it, which is going to be stock purchasing or income, how to use it, which is obligation delta POP. Don't worry, you're not expected to know all this stuff. I'm going to go over all this stuff today. And finally, what to expect as far as managing losers and profits and losses. So as I mentioned up top, important to note, this is an advanced option strategy. So if you're new to options, if you're just started trading them, if you're not familiar with basic option, what they call defined risk strategies like verticals and iron condors, this is not the strategy you want to start learning how to trade with. But as I mentioned, it's definitely a good thing to sit through and see, because this is where you're going to eventually end up. And just to know it exists and how simple it can be once you learn it is a good thing to know. And important over here, because we're going to go through a lot of information today. Obviously, I can't cover everything. But every term or concept that I talk about here is explained in the other courses I teach. So if you don't understand something, you can email me and I'll tell you where to go to find out what I'm talking about. Because like I said, we're going to drop a lot of terminology in here. And like I said, just go with the flow. If you got any questions afterwards, just email me. Okay, so these are my courses. Obviously, got to just give you a quick blast on what these are. So if you've never done anything with options, this is what you would do. You would start here under Understand Options Completely, and this is going to tell you everything you need to know about options. Shares, expiration dates, time frames, strike prices, bid-ask spread, liquidity, that kind of stuff, calls and puts. So if none of that stuff makes sense or you're not familiar with it, obviously good to know. Over here, basic option strategies will get you the 5 trading rules, teach you about verticals and iron condors, trade mechanics, volatility time, liquidity, etc. Over here, if you're rate trading, super important. This is really the key to trading when you're all up to speed and you know how to trade as far as strategies. Making and managing trades is everything. This is kind of the art of trading, because it's part science, part art form. So this is obviously where you'd want to end up. But if you started with nowhere, I'd start over here and just go to the right. I feel like somebody, hang on. Okay, there it is. Sorry, I didn't meet anybody. Okay, so once learned, what's the time commitment with this? Very easy. Probably you can knock this out in the morning before work. 15 minutes a day, you can absolutely make trades and manage them. It's not a really time-consuming thing once you're up and running. So let's get into more of what we're talking about. So let's just start with the basics. What is an option? We've all heard of stock. Stock equals shares. When you buy stock, you're buying shares in the company. You're actually buying a piece. One option is what they call leveraged product, which means it equals 100 shares of stock. So if you have an option, you essentially have 100 shares of stock. So the most important thing to know about selling naked puts is you need enough money in your account to buy 100 shares of stock in whatever stock you do this in. So let's show you what that means and why it's so important. So first off, how do we make money with options? Oh, we lost one. So our assumption with naked puts is the exact same thing as buying stock. They're theoretically the same thing. Okay, so when you buy stock, what do you want to happen? Well, obviously you want the stock price to go up, right? You buy it at a certain price. Your assumption is the stock price will go up. And let's just say for this example, we buy the stock at $100. So when we buy stock, where do we make money? We make money when the stock goes above $100. Pretty simple. It's real easy. But now let's look at a short put and see how that changes things. So for this assumption, we're going to do the same thing. We're going to assume the stock price is at $100. And in this case, we're going to sell what's called the 90 strike. So what does that mean? What that means is at expiration of this option that we sold, the short put, as long as the stock price is above $90, we will make some money. And anything above, sorry, gotta show you here. Our assumption is it's a $5 credit, sorry. So the max we can make when we sell anything is what we sell it for. So in this case, if we sold it for $5, the most we can make is $5. $5, because it's leveraged product, means $500. Remember, with options, everything is times 100. So if we sell it for $5, our max profit is $500. So at expiration, if the stock price is above 90, remember, when we make this trade, the stock's at 100, so we got quite a bit of cushion here. Anything above 90, we keep all $500, this whole area here. Sounds pretty cool, right? Obviously, it seems like it'd be a much better chance of making money if we're selling something down here than buying stock up here. But there's an added benefit to the short puts, and that's something called cost basis or break-even price. And what is that? Well, when we sell this put for $5, we collect that money up front. We sell the put, $500 goes into our account. Now, we may not keep all of it. That's the most we can make. But it goes into our account right away. And when it expires, we're going to keep some portion of it, or if the stock goes way down, obviously we'll lose some money. But the beautiful thing is if we sell the 90 strike for $5, we end up with a break-even or cost basis price of 85, which means at expiration, if the stock price is anywhere above $85, we actually make some money on this trade. And it's a one-for-one basis. So what I mean by that is if our cost basis is 85, let's say the stock closes at $86. How much have I made? I've made $1, which means I've made $100 on this trade. If the stock price closes at 87 at expiration, I actually make $2 on this trade, which is $200. So I think you can see now why at 90 we max out. At 90, that's $5 above here. Obviously, that's the difference. We keep all $5. That's the most we can make. So $500 right here is the most we can make if it closes above 90. If it closes below 90, anything above 85 is a profitable trade, exactly like this, one-for-one basis. Hopefully that makes sense. So when do we use short puts? There's two kinds of scenarios we're going to use short puts. One is if you want to buy stock, and one is if you're trying to make a monthly income stream. And you can see right here, these two things are exactly the same. Our first two, assuming stock price increase and assignment obligation to buy, are the same for both scenarios. So let's take a look at what that means. So we already seen stock price assumption is we want it to go up, just like buying shares. So I'm going to drink some water. But what happens if things go against us? What if things go, bad? This right here, assignment, assignment, if the stock price is less than the strike price at expiration, we have something called assignment. And this is why it's super important to be able to afford the stock that you're doing this on. So what does that mean? We make this trade when the stock price is 100. We sell the 90 strike. If the stock price is below our strike price, here's our strike price. So if the stock price goes down below 90 bucks at expiration, what happens? We are assigned 100 shares of the stock, which means we're forced to buy 100 shares of the stock. Now, a couple things. First off, what price are we buying this at? Well, we're still going to keep all $5 that we sold. So when we're assigned the stock, even though it's closed below 90, we're assigned the stock at a cost basis of 85. And that's how we can still make money on this trade. We're going to get assigned 100 shares below 90. So if the stock closes at $89, we are going to be a $4 winner, right? But we're going to have 100 shares of stock in our account now. At a price of 85 is what we're going to be forced to buy it at. So even though we're profitable, we're still going to get assigned the 100 shares, just the stock will be assigned at $85. So we're still a winner, but now we have a much bigger capital requirement in our account, right? Before it was just one option we were selling, but now we've been forced to buy 100 shares at $85. So we need $8,500 in our account. That's why having enough money in your account is so important. So this is super important. If the stock price closes below our strike price at expiration, we're going to be assigned 100 shares of that stock at our cost basis, our new cost basis of 85. That is a mouthful, I understand. Don't worry, I can go through this multiple times. I also have this as one of my courses in more detail you can take as well. But that's the gist of what assignment means. Stock price closes below strike price expiration, we're assigned 100 shares at our new cost basis. And so why is that so important? Obviously, you see 100 shares can be expensive, but what people like to do, I'm the same, right? What's the first thing you want to do? You're like, hey, I can make some money doing this. Here's the price of this stock. This, at the time we did this, is price line, 18.18. And if I sell a 17.15 put, which is over $100 below where the stock price is now, if I sell this put in 46 days, which is what this is showing till expiration, I'll keep $1,110. That seems like, wow, no-brainer, right? Why wouldn't I do this all day long? There's no way the stock can close $100 below this price. And it's only 46 days. It's a month and a half away. And as long as it stays above that number, in 46 days, I get to keep like over $1,000 in profit. Seems like I would just do this all day long. But as we all know, crazy things happen in the stock market. So if by some crazy chance the stock did close below 17.15 in 46 days, what happens? We're going to be assigned 100 shares of this stock at 17.15 minus our credit per share. So 17.15 minus the $11.10 per share that we keep, that total, means we're going to be assigned at our new cost basis of 17.0390. 17.15 minus 11.10 gets us a cost basis of 17.0390 times 100 means we're going to have $170,000 of stock assigned to us in 46 days. That's why we don't do this all day long, because if something crazy happens and the stock shoots $100 down, which is entirely possible, as we all know, I'm stuck with $170,000 plus worth of stock. That's why it's so important to understand that when you do this on stocks, if you're forced to buy the stock, you better be able to afford 100 shares of that stock. So assignment, very key to understanding selling puts. Like I said, it's just something you have to be aware of, and you have to be ready to absorb the hit if it happens. And obviously this is an extreme example with the most expensive stock I could find, just because you can make a lot of money in a month and a half, but if things go wrong, you can get stuck with a lot of shares. So that's assignment. Okay, so now we've covered assignment. Let's go on to the other two. Stock you'd like to buy or monthly income stream. What's the difference? Well, as you see here, if it's a stock we'd like to buy, we're looking to purchase it at under market value, and we're going to sell a strike that's at the money. I'll show you what that means. If it's a monthly income stream, it's a stock we don't want to buy. We just want to collect that monthly income stream from the put. But if we're stuck with it, we don't mind being stuck with 100 shares of that stock at our cost basis, and we're going to, so because of that, we're going to sell a strike further out of the money. So let's see what that looks like. But before you go to trade page and I show you, here's our checklist for trading puts. And once again, this is the driving the car thing. Absolutely, if you want to go out and do the research yourself and figure out your own rule set, I always encourage people to learn more. But these are the rules for trading puts correctly. And I'm going to give them to you now, and then we'll go through them to show you how it looks on a trade page. So the golden rule of trading puts is we never, ever, ever sell a put strike above our stock price. That's just the golden rule. We don't do it. Factors. When we're doing our trades, here's kind of the rules we're going to go. We're going to go as close to 45 days as possible. Volatility rank greater than 50 is preferred. Don't worry, we're going to go through all these and explain them. POP. POP is your probability of profit, which is your probability of making at least $1 profit on this trade. What's my chance of making any profit on this trade? That's what we call POP. And delta is a good substitute for POP. And because of POP, don't worry, I know this is getting crazy if you've never heard this before, we're going to be able to pick our win percentage on this trade. And of course, break-even cost basis is important to know because that's the assignment price if we get stuck with it. So real quick, let's go over a couple of the basic rules. Like I said, I cover all these rules in other places, but these, at least for today, are the couple you really need to know in order to have this little scenario make sense. So rule number one, duration over direction. What's our trading rule? We trade as close to 45 days as possible. Never less than 30, and we prefer it to not go above 60, but if it's a choice between 29 and 61, we're going to go with 61. So if this is a option chain on a trade page, you can see right here, these numbers are actually telling me the days to expiration. So if you can't read them, it says 9, 37, 100, 128. So knowing our trading rules, trade as close to 45 days as possible. What's the first thing we do? If we're going to make a trade with this particular stock, which option chain are we going to use? Obviously, it's going to be this one at 37 because it's as close to 45 and it fits between 30 and 60. So we're going to use this October 37 days option chain as the option chain we use to trade. So that's rule number one, trade as close to 45 days as possible. Number two is volatility. And what is volatility? Volatility refers to how volatile a stock's price can be. What does that mean? High volatility implies a stock's price is volatile and can move up or down dramatically. In layman's terms for us, all we need to understand is high volatility or more volatility means something is more expensive. Less volatility or low volatility means something is less expensive. So we prefer a volatility rank over 50 because if we're selling something, remember we're selling puts, we're shorting puts, we're selling naked puts, all synonymous terms. If we're selling something, obviously we prefer to sell something expensive over something cheap. And when volatility rank is over 50, that is telling us that these options are relatively expensive, and we want to sell expensive things. Now, it's important to note right here that you cannot work out volatility on your own. You have to have a piece of software that shows you that. And I'm in no way telling you to use these two platforms. These are the two I use, but go out and find whatever platform you want. But the only two platforms that I personally know of and use that show me volatility rank are currently Tastyworks and the Thinkorswim platform on TD Ameritrade. And like I said, go out and use whatever platform you like, but these are the two I use, and these are the two that both show you volatility rank, but feel free to go out there and do some research if you want to find another platform to use. So what does high volatility look like compared to low volatility? And this is just a quick illustration to show you why volatility is so important as traders. So I chose two stocks. Stocks aren't important, but they're Yahoo and something called the XME ETF. But I chose them for a few main reasons. One is the stock prices are both essentially the same. They're both right around $41. I'm looking at the strike prices that are the same. I'm 41, 42 for both. And I'm using the same option chain, October 37 days. So essentially, these stocks look exactly the same on paper. Same option chain, same strike prices, same stock price. So what does high volatility look like compared to low volatility? Well, look, if I look at the 41 strike over here, look at what these are selling for. And if you can't read it, it says 278 to 281. Down here, the 41 strike is selling for 114 to 125. Wow, right? It's almost 2.5 times less, or 2.5 times more up here. The 42 strike, 235 to 238. Down here, 70 to 75. So up here, it's almost 4 times the price. That's what volatility does for us. So we're not going to look through 1,000 stocks at the $41 price number trying to find out which ones are volatile and compare strikes to each other. The volatility rank will tell us that without having to do that research. And that's why volatility rank is so important, and that's why you want a platform that can show it to you. Because you can just look and see where's the volatility rank on this. It's high. Then you go look at those options, and it should inherently tell you that those options are selling for more than these options, and that's strictly because the volatility is higher. Okay, so as I said, probability of profit, here it is kind of spelled out. POP for short, just easier to say because probability of profit is a mouthful. More water. Okay, I'm hydrated. So probability of profit, POP from now on, is just the probability of making at least $1 on profit on that trade. Shortcut to POP is something called delta, which I'll show you. Break-even price and cost basis we saw already. What it actually means is a break-even price is just where the buyer and the seller of the option make no money. So if you sold the option, if you bought the option, both of you essentially broke even. Nobody made money, nobody lost money. And it's a real simple formula for working out break-even price. All we're going to do is take our strike price, which remember was 90 in the case we used. We're going to subtract out the credit we received, which remember was $5. And that leaves us with a simple break-even price or cost basis of 85 bucks. Simple formula. Strike price minus credit received equals our new cost basis or break-even price, synonymous terms. Okay, so finally we've made it to a trade page. So I'm going to go through this, and we're going to do a live example as well. But let's just look at a trade page and go through our rules up here one by one to show you like how easy this really is to do on a trade page and what these different terms actually mean. So, first off, 45 days to expiration, okay? In parentheses here is the days to expiration. So you can see 11, 18, 25, 32, 39, 46. If we want to be as close to 45 days as possible, hopefully you see right here, 46 is the closest one. So this is the option chain we would use out the gate, as long as it's liquid enough. We'd use this 46 days. So rule number 1, boom, done. How about rule number 2? Strike price less than stock price. We never sell a strike price above our stock price, only below. So if our stock price is 138.58 and we only sell strikes that are below our stock price, obviously everything from 139 up is out of commission because these strike prices are above our stock price. And we never sell a strike above our stock price. We only sell strikes below our stock price. So if we're going to sell a put, it's got to be somewhere in here. Anywhere in here is completely fine because these are all below the stock price. Volatility rank, greater than 50, you can't see it on this page. Like I said, it's a preference, not a requirement. So you can absolutely trade things without having volatility ranks above 50. And in many cases, like right now in the market, it's very near the high ends and volatility is very low. So finding stocks with greater than 50 volatility rank is tough. So it's just a preference. If you can find it, great. If you can't, not a problem. You can trade without it. So now we get to a little more complicated, which is inverse delta equals POP equals out of the money percentage. Pick your win percentage. What a mouthful. So what does that mean? Let's start with delta. Every platform should have something called delta, if you can find it. And what delta means is your chance of losing money. So I put this right here next to it. Probability of being out of the money. They're synonymous terms, and all it means is inverse, right? You see I said inverse delta, which means just subtract delta from 100, and it'll give you your chance of making money, your probability of profit. So you see, if I subtract 7 from 100, I get 93, and this over here says just above 92. Again, this is just a shortcut to find out your POP. It's not the exact, but you can see it's pretty close. So if my delta is 15, what's my probability of profit? Subtract it from 100, it should be about 85, and it is. Over here it says 83. Again, this is a shortcut to finding it. My delta is 31. What's my chance of making money? Subtract it from 100, should be about 69. This one is about 67. Again, just a great shortcut. And that's how you pick your win percentage. What do I want my chances of making money to be? Well, I get to pick it just by picking the delta. Hey, Cal, I want a 90% chance of making money. Okay, then look for the 10 delta, and that'll give you a 90% chance of making money on this trade. It's that simple. I'd like a 80% chance of making money. Okay, take the 20 delta, and that'll give you your 80% chance of making money. Now you might say, well, okay, then why wouldn't I always go 99% chance of making money? Who wouldn't want a 99% chance of making money? And that brings us over here to this, because everything is a trade-off. Trust me, there's a lot of smart people involved in the stock market, and they've thought of everything. Higher POP equals lower income. So before we just spell it out, what does that mean in your head? The higher the chance I have of making money, the less amount of money I'm going to be able to make, which makes sense, right? I mean, if you take a lot of risk, you expect a lot of reward. If you take very little risk, you expect very little reward. And that's exactly how the stock market works. So if you see over here, as the put prices go down, which means we're getting further away from the stock price, right? Which means our chances of winning are higher, right? We're getting further and further away. Obviously, there's a better chance of a 124 put being a winner than a 137 put being a winner. This is $1 away. This is $14 away. And you can see it over here that that's how it plays out. Obviously, the further we get away, the higher my chance of making money. Makes sense. I'm further away from the stock. Obviously, there's got to be a better chance of making money. But what's the trade-off for that? Higher POP, lower income. So let's look at, we'll just look at a column to make it easy. Let's look at this. When I'm just $1 away, they're willing to sell me this put for $2.24. But as I get further away, way down at 124, I can only sell this put for 34 cents. So that's the trade-off we make every time, higher POP, lower income. I can have a 93 roughly % chance of winning, but if I win down here, I'm only going to collect $34, let's say, or somewhere in the middle, 32. And after commissions and all that kind of stuff, maybe I walk away with like 20 bucks. So is the risk worth the reward? Over here, I can make a lot more money. I can sell for $2.24, but you can see there's just a 57% chance of making money on this trade. So more risk, more reward. It's more like a coin toss. I'm very close to the stock price, so I'm taking more risk. I expect more reward. So that's exactly how the stock market works. Higher POP, lower income. The further we go away, the better our chance of making money, the less money they're going to give us. The more risk I take, which means the closer I am to the stock price, the more money I can potentially make because they're willing to sell it to me for more because the chances of winning are much lower. And finally, hopefully that makes sense, finally is cost basis break even. Again, remember the formula. So let's just look at 2 strikes. Let's say it's the 124 strike. I can sell that for, let's just make it simple for math purposes. Let's say I can sell it for 30 cents. So my break even price or cost basis, if I get put the stock, is 123.70. If I go all the way up to the 138 strike, you can see I can sell that, just for ease of math, we'll say roughly 250, which means my break-even cost basis is 135.50. So once again, I can collect a lot more, but my cost basis up here is going to be higher. So I got to be prepared. If the stock closes below 138 at expiration, I'm going to get put 100 shares of stock at 135.50, which means $13,550 worth of stock. We're down here. Obviously, there's less chance I'm going to get put the stock, but if I do, it's way down here at 123.70 times 100 means I'll get put $12,370 worth of stock in my account. That's why cost basis break even is so important. First off, you can see how far away it is, and if I get stuck with the stock, what do I have to be able to afford in my account? And this will tell you right there. So hopefully all those rules make sense. So we get back to buying stock versus monthly income. What do we do, and how do we decide? Well, it's pretty simple. So here's the stock price, 138.58. So if I'm looking to buy the stock, I'm looking to take more risk, right? I'm looking to buy the stock, but I don't have to buy the stock. If I can collect a lot of money, I'd be totally happy with that and buy the stock again later. So if you're willing to buy the stock, you're willing to take more risk because you're totally happy buying the stock right here at 138.58. You like the stock, you think it's going up. So what I'm going to do when I want to buy stock is I'm going to sell the put closest, the one just below the stock price. And the reason I do that is I collect the most money. I collect 255. So right now the stock's at 138.58, so I'm only 58 cents away. But remember, my assumption was the stock's going up. And if the stock stays above 138 at expiration, I'm going to keep all $255 here. But if I'm wrong and the stock goes down, I'll be buying stock at 135.45, which is still way better than buying it at 138.58. So I was happy to buy the stock here, so I'll take more risk, and that way I can collect more money. And if I'm wrong, I'm still buying the stock at well under market value than it was when I started. Now on the flip side, if we're looking for monthly income, we don't want to get put the stock, right? We want to get as much money as we can with the best odds of making money as we can and hopefully walk away without the stock. So we're going to pick something that's a little bit further away. And in general, the starting point is we're going to want to sell what they call the 16 delta, which is going to give me a roughly 84% chance of making money. So right here, in this particular example, there was no 16. The 15 was the closest. But if I'm selling it for monthly income, the best bang for my buck is the 16, roughly the 16 delta, which should give me a roughly 84% chance of making money. So in this case, if I was looking to do a monthly income trade, I would sell the 130 put. I'm only collecting 71 bucks. So if it stays above 130 at expiration, which is still $8.58 below where it is now, I'll be able to keep all $71 at the end of the expiration period. And if by chance something goes horribly wrong and I get put the stock, all the way down here at 129.29. So it's almost $10 below where it is as of the day I make that trade. So that's the difference. Up here, we're looking to sell puts for more money and roughly take a 50-50 bet on the thing because we don't mind getting put in the stock, but we'd like to get as much money out of this trade as we can. Down here, we're not looking to take as much risk. So we're going to go further away. We're going to sell whatever delta we want. I generally shoot for the 16 delta. And we're going to collect a little bit less, but we're going to have a much better chance of making money. You can see here there's an 83% or 84% chance I'll make money on this trade, where up here it's just above 50-50. That's the difference between buying stock with puts or trying to create a monthly income stream with puts. Hopefully that makes sense. Before we go to a trade page, a live one, let me just take another quick sip and hydrate. Feel free to hydrate as well. Okay, there's our rules. So let's go to a live trade page and put them in action right now. So here's a live trade page. This is the TD Ameritrade Thinkorswim platform. What I'm using for this is the SPY, only because it's the most liquid stock in the world. I just want to show you like all the various option chains, blah, 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 etc. So first off, rule number one, as close to 45 days as possible is where we want to trade. So if this platform shows you right here in parentheses the days to expiration, what option chain do I want to use, assuming the liquidity is there? I want to use these right here. Why? Because that's 44, which is as close to 45 days as I can get. Now, can I use any of these? 30, 35, 37, 51? Absolutely. You can use anything out of those four. These all fit the rules, but 44 is really right spot on our rule. So if we have a chance, we're going to want to go with as close to 45 as we can, which is the September right here, September 22nd, 17. So rule number one, that's our option chain. We found it. So I click on that and open it up. Now, if I go down to the very bottom of this platform, it shows me today's option statistics. Let me just see something real quick. Okay, so on this platform, it says current IV percentile, which is another term for implied volatility rank, and you can see it's 17. Now, will we prefer something above 50? Absolutely. But like I said, in this market, there's not a lot of stocks above 50. So just for this example, to make it simple, we're going to the SPY because it's the most liquid stock in the world. But you can see this is where you find the volatility rank. Any platform you choose, hopefully you'll be able to use that as well, because you can't do this on your own. So in this case, it's 17. Not perfect, but it's just a preference, not a requirement, so it still meets our rule of volatility rank. Now let's go down to our option chain. So if the stock is 247.25, what's our golden rule? We never sell a strike price above the stock price. So if the stock price is 247.25, hopefully you realize 247.50 and above are no-goes. You can actually see on this platform, they actually highlight what they call in the money and out of the money. So in this case, all these out of the money strikes, these are no-goes. It breaks our golden rule of selling a strike price above our stock price. So 247.5 and above, out of the picture. So we're going to choose a strike price somewhere in this neighborhood. Okay, and then it's as simple as what kind of POP am I looking for and what kind of reward am I looking for? As I mentioned, for me, I'm always looking for the 16 delta. So it's going to be one of these two right here, somewhere in this neighborhood. And either one of these in my world is totally fine. You're collecting enough money to make it worth our while, and we still have a roughly 84% chance of making money. But you can choose any strike you want anywhere in this chain. This is the monthly income choice. If I want to buy stock, what am I going to do? I'm going to sell the strike price right below the stock price, which is right here at 247. And you can see I'm going to collect a lot of money there, 3 times as much money. And why is that? Because I'm taking more risk, right? It's roughly a 50-50 shot. But if I'm right, I'll collect $300+ plus. And if I'm wrong, I'll be buying the stock at 247 minus the credit received, roughly, let's say, $3. So I'll be buying the stock at 244, worst case scenario. So just to highlight it, if I'm doing a stock purchase game, I want to sell this put to get the most money possible. If I'm doing a monthly income stream, me personally, I'm looking at the 16 delta, so one of these two is my neighborhood. But you're absolutely welcome to choose any strike price you like. You might say, Cal, $1's not enough for me. I'm looking for roughly $1.50 if I sell an option. Okay, then 240 is your number right here, because you can see there's a 25 delta roughly. It's a 75% chance. So the $1.50 is going to give me a roughly 75% chance of making money. It's really that simple. That's how the POP, delta, pick your win percentage all comes together. All we do is take the delta and subtract it from 100 to get our probability of profit. That easy. And of course, just real quick, if we're doing the stock purchase, then we want to know that 247 minus the credit received, for ease of math, I'm going to say 3, means my cost basis is 244, which means I will be forced to buy $24,400 for the stock if the stock price closes below 247 in 44 days. Up here, if I choose my neck of the woods, let's just say it's $1. So if things go horribly wrong, the strike price minus credit received means my cost basis is 234, which means I'll be forced to buy $23,400 worth of stock if things go horribly wrong in this scenario. So it's about $1,000 difference in what I'm required to buy if I go way down here. And obviously my chances are way higher that this won't happen. I have a 85% chance of making money, which means like a roughly 15% chance of losing, where here it's a 50-50 bet. But I can make a lot more with a lot more risk. Make a little less with a lot higher chance. Higher POP, lower income. So hopefully that all makes sense. So let's go back here. So what should we expect with short puts? Managing winners. With stock, we're going to let the option expire. With monthly income, we're going to manage our winners at 50% profit for the monthly income. Profits and losses, assignment. Again, it's good to know what assignment is, so what I'm responsible for. But if things go against us, we have a couple of options. We can do something called a covered call, or we can do something called rolling. So let's look at the Tastytrade example. I always like to give them props because I learned everything from them. So this is an example of managing winners and why we do that kind of thing. So we're going to look at here is they took the SPY stock, which I just showed you, and they did it from 2005 to present. And what they did was they sold the 16 delta put, which is, like I mentioned, what I do as well. It's close to 45 days. Gee, what a coincidence. Everything's exactly the way I do it as well, because guess what? This is where I learned it. And they do all the studies to back up their research. And what they did was they compared the strategies. Expiration, so stock purchase, versus managing at 50% profit. And what happened? So we're going to go through this one by one because it's super important. So let's just assume right here, this is a stock purchase because we're going to let go to expiration. And this over here is our monthly income stream. So you can see, first off, profit and loss is what this stands for. If I let all the puts go to expiration, I end up making $89.34 compared to only $64.67 on the managing side. So why would I ever do that? I make way more money up here than I do when I manage these puts. And the percent of winners is pretty close, right? It's roughly 94, and this is 98. Now 4% doesn't look like that much, but in reality it is actually quite a big difference. But let's just let that slide for a second. So why would I ever choose managing winners over expiration when the dollar amounts are so different? And that's because of this down here, largest drawdown. So what does that mean? Well, when you let stock go to expiration, obviously you're going to get put stock at some point. And if you do, you're going to get hit with a pretty big drawdown. Drawdown means the loss on your trade. If I'm managing at 50%, I'm going to manage these a lot quicker, right? It's going to be a much shorter trade. And when you hold stock till expiration, you can see my largest drawdown was almost $1,000 in one case. Whereas when I manage them, it was only 200. So wow, right? It's almost a fifth as much what they call volatility of returns, right? I mean, the most I lost from managing was $200. Over here, it's almost 1,000. So even though I made a lot of money up here, $2,000, $2,500 more, I took a lot of risk to do it. And in my world, I do everything essentially for managing winners and monthly income because I'd rather just collect money with a lot less risk involved. So that's number one. So if you buy the stock, great. You're going to make more money over time. You're going to have more risk because you're going to get put the stock, have bigger losses, etc. But that's okay. You don't mind because you're looking to buy stock and take more risk. If you're looking for monthly income, we're looking to manage it. We're going to make a little less, but we have a higher percentage of winners and a much lower drawdown if things go against us, which is great. The other beautiful thing, and really the most important thing for me, is average profit and loss per day. So what does this mean? Well, at expiration, that means I've held on to this for 45 days. So if you divide out my profit by 45 days, it's going to work out on average to $1.55 per day in profit. Remember, this is always, $1.55 in profit. When I'm managing at 50%, what happens is my profit and loss per day almost doubles. And why does that happen? That's because we're managing things much quicker. We're not holding on to them for 45 days. We might hold on to them for 15 days or 20 days. Whatever the number is, it's a lot less. So I'm collecting a lot of money in a shorter amount of time, which means every day I'm collecting more money. Over time, yes, I'll make more money with this, with more risk. But just on a daily basis, if I'm doing this multiple times, I'm making more on a daily basis by managing my winners. So that's why managing winners is so important. Expiration, this stock purchase guy, which is a great way to do it. But if you want a monthly income, we're going to manage at 50% because that's going to increase our percentage of winners, increase our profit and loss per day, and also reduce our risk or largest drawdown. So if you don't understand what managing winners is, that's what this course is, I mentioned at the front, make and manage profitable trades. The key to trading in the end, once you know how to make a trade, once you know how to sell a put or do a vertical, any of that stuff, the key to trading is all of this. Making and managing trades is really the art form involved in trading. So if you need to learn this stuff, and I recommend if you don't know it, everybody should, you don't need fundamental analysis and technical analysis. My stuff is making a trade will get you into the stocks, how to pick them. Stock picking, liquidity, watching out for earnings, volatility, how to decide on direction. And really managing trades is the key to everything. Trade small, trade often, position sizing, drawdowns, singles versus home runs, duration over direction, which you saw I showed you was the 45 days. And then finally down here, managing winners is the final step. But this is really the key to successful trading is making and manage profitable trades. And finally, the other thing I mentioned about short puts was covered calls and rolling. So are there ways to avoid assignment? If I make that monthly income trade and things go horribly against me, is there anything I can do? Sure. There's 3 things you can do, actually, to avoid assignment. One is you can close that trade, right? If the trade goes way against you and you're losing too much money and you don't want to take any more risk, you can just close that trade and take your loss. That's the easiest way to avoid assignment. Just close early. Don't wait till expiration. Now, if you get to expiration and you get assigned the stock, the first thing you want to do is something called a covered call, which means you're going to start selling calls against it to reduce your cost basis. So if you get into the short put game, I highly recommend you take the covered call option strategy course because this is going to happen to you, whether you believe it or not, no matter what your POP. At some point, you're going to get assigned stock if you hang on to these things. And you're really going to want to know what to do next if you get assigned stock, and covered calls are what you want to do. The other thing is called rolling. And eventually I'll do a course on this because this, again, is more of an art form than a science, but it's a pretty complicated subject. So I encourage you, if you don't know anything about it, go online and look around. Like I said, eventually I'll get to it and make a course about it because it's a whole course in itself. But you can also roll your puts out to avoid assignment as well as an option. So just to show you everything that I have as far as courses, these are the 3 I mentioned. If you want to learn how to trade, these 3 in this direction would be the best way to go. Obviously, I think this is really important for everybody, but all these are super valuable options, strategies, and make and manage. I also get into advanced option strategies with multiple variations on iron condors, if you know what those are. Here's the covered call. And this course that I'm kind of giving you today, this is just the same course I just kind of explained to you, just a little bit more detail. And also, just so you're aware, I have an alert system available now that's free, just because I'm going to probably be doing it through the end of the year just to kind of get people up and trading. So please feel free to take advantage of that. You can go to Sharper Trades and sign up there. It's absolutely free. There's no, whatchamacallit, you're not forced to do anything. It's an absolutely free system. Like I said, I'm just giving it away because I want people to get up and trading as fast as possible. So hopefully you left your day understanding at least a few of these things, or if not, at least becoming aware of them. This is a lot to comprehend in just an hour. I went quickly. This is probably something you want to cover or go over a few times. But once again, I wanted to show you a way to buy stocks at under market value. So again, that'd be selling the at-the-money put. A high probability way to earn a monthly income using options. That would be the further out of the money put. Remember, higher POP, lower income. Showed you how to pick your winning percentage on every trade using the delta as kind of your starting point and just doing the inverse delta or subtract from 100. And hopefully this at least shows you that it's not very complicated. Once you learn it, it's a pretty simple process and you can knock it out literally in 15, 20 minutes a day. So hopefully this gave you at least nothing else the desire to learn more about option trading. Now, I'm always available for questions. I love answering questions. I love this stuff. So anytime you have a question, if anything here was over your head, didn't understand it, or you just want some clarification, absolutely email me anytime at cal@optiontradingforrookies.com, and I'll get back to you as soon as I can with an answer. But I love answering questions because that means you want to learn and I want to teach you. So thanks for your time. Hopefully you got some value out of this. And like I said, either way, happy trading, and hit me up with any questions you have. And look at that. We're right under the wire, so we knocked it out in an hour. So hopefully you learned a lot here today, and it inspired you to learn more. Take care, and thank you so much for joining me, and hopefully I'll see you again at my events. I do these the first Wednesday of every month at the same time, 5 o'clock Pacific time in Los Angeles. So once again, thank you all for joining me, and hit me up with any questions you have. Take care.